All right, good afternoon, everybody. We're going to go ahead and get started now. I don't want to wait too much longer. I know people are still filtering in, but hopefully, well, as we go through a couple housekeeping items, everybody will be in. Before we jump in, I just want to highlight a few things for everybody. First of all, for those of you that don't know me, my name is Ryan Melliker. I'm the president and co-founder of Lodging Analytics Research and Consulting, or LARC for short. Thank you for joining us today. We are going to walk through our US outlook as well as dig into a bunch of markets. But before we do that, I just want to let you know a few things. Number one, this webinar is being recorded. We will have the recording posted on LARC's website, larkanalytics.com, probably tomorrow, certainly by the end of the week. So if you have to jump off, don't worry, you can see the rest of it later on. Point number two, everybody that is on this webinar will receive a copy of the slides. You don't need to ask me for the slides, you will get them. We will get them out later today or at latest tomorrow. Third point, there's a lot of material we're going to go through. I'm probably going to talk really fast. My apologies in advance. But what I will tell you is that you will have Q&A at the end. As I'm sure you guys are all aware by now with all the Zooms, we know how they work. There's a little Q&A button in your Zoom menu that you can lob questions in. We're going to go do our best to get through all of them. If we don't get to answer your question, feel free to email me, information@larkanalytics.com. Next, I will be at the lodging conference next week with my business partners, Evan Weiss and Dan Lesser from LW Hospitality Advisors. If anybody's interested in learning more about LARC or our services, feel free to reach out. Happy to set up a time to chat, whether it be in person out there or over the phone. And lastly, which is kind of exciting, just kind of a little teaser for everybody here. You know, as I'm sure you're all aware, at LARC, most of the work that we do is focused on market level forecasting. But we're rolling out a product in a few weeks now that is much more asset centric. It's actually a technology product. It's a GIS application where you can actually find out all the detail related to demand drivers within proximity that you select of any hotel in the US. It's really pretty exciting. We think it's going to revolutionize how individual assets are underwritten. And as that comes out, happy to share it with anybody. Just reach out and we're happy to walk you through a demo. With that being said, we're going to go ahead and get started now. Thank you all for joining us. So there's a lot to cover, as I mentioned. We're going to walk through a market review of the US, talk a little bit about how this recovery is different, the economic outlook going forward, then the our US lodging industry outlook, and then we're going to walk through our market highlights. So that being said, the market review. So the recovery is progressing pretty nicely, but there's a couple of things that I'd like to highlight on this slide. You know, obviously you saw a pullback from the Delta, and this is data relative to 2019 levels. You saw a pullback following the Delta variant with the Delta variant and then with the Omicron variant. But generally, ADR and Revpar have continued to be pretty strong and trending in the right direction. What's kind of interesting about this slide is the simple fact that occupancy appears to have kind of plateaued a little bit over the last few months relative to 2019 levels. It is not accelerating like ADR and Revpar are, which is just something to keep in mind. It's going to be a general theme we're going to talk about throughout this presentation, what's happening with occupancy and where it's going moving forward, but it's something that we think is worth highlighting. Let's take a look at, you know, just a little bit of a backdrop of where we've been. So 2021 US Revpar was 17% below 2019 levels for the full year. There were only a handful of markets that were above 2019 levels, all very leisure centric: Mobile, Palm Beach, Norfolk, Charleston. And this is the 47 markets that we track on a quarterly basis. Market divergence was extreme. Mobile up over 20% over 2019 levels. San Francisco still 65% below 2019 levels. Fast forward to a point in time, June 2022 versus June 2019, and you see a vastly different story, right? June 22 US Revpar was 10.3% above June 2019 levels. That's a typo, we'll fix that. 34 of LARC's 47 markets were positive versus 2019 in June. That's up from just 10 in March. Big move, right? Market divergence remains extreme. Palm Beach, 35% above 2019 levels. San Jose, San Francisco, you'll notice we pick on those guys quite a bit. Down at the bottom end here, down 20%. And then if you look at ADR, similar story to Revpar. US ADR ended the year 5% below 2019 levels. Only 6 markets were above 2019. Divergence was extreme. Miami had positive ADR, 14% above 2019 levels. San Francisco down close to 40%. And then again, point in time, June 22 versus June 19. June US ADR was over 15% above 2019 levels. Almost all of the markets that we track, 45 of the 47 markets we track, had ADR above 2019 levels in June. The only 2 markets that didn't were San Francisco and San Jose. Market divergence remains extreme. Several markets are up over 30%. Palm Beach up over 40% relative to 2019 levels. And like I said, San Jose, San Francisco still negative. If we look at TSA throughput and what that's telling us, I think the big highlight that we'd point to on a 14-day rolling average is, well, there's some noise related to holidays, Labor Day here, July 4th here, Memorial Day here. Generally, if you go back to, basically mid-March, early April, all the way through August, we've been stable in terms of TSA throughput at levels roughly 10% below 2019. There have been some spikes related to holidays, but ultimately that's 5 months of stable TSA throughput where you're not seeing any pickup. Just an interesting point that that kind of goes back to the idea that over the past few months, occupancy seems to have stabilized as well. So has TSA throughput. And then if you look at booking volumes, it tells the same story. If you look at this chart here, the lighter colored line is the US, the darker colored line is global. And what you see in this lighter colored line here in the US in terms of hotel booking volumes as a percentage of 2019, again, you get some spikes related to holidays, Labor Day here, July 4th here, Memorial Day here. But generally speaking, you're looking at volumes that have been relatively stable at around 90% of 2019 levels, 10% below 2019 levels. All of this data is telling us the same thing, that demand volumes appear to have stabilized over the past few months, and that's no longer in this recovery period. And now what gets it to expansion? The other thing that we highlight on this slide is just that booking windows remain very short. We haven't seen elongated booking windows. That's not too surprising, and just something that's worth highlighting. So why is this recovery different? Well, let's just walk through it a little bit. So first, let's take a look at how this recovery is, in terms of Revpar, has performed relative to past cycles. The dark blue line here is this cycle. The light blue lines are the prior 2. And what you'll see is obviously this cycle fell further and bounced back much further, much faster. In fact, the reality is, following the great financial crisis, it took 59 months to get back to prior peak level of Revpar on a rolling 12-month basis. Following 9/11, it took 52 months. US Revpar reached 2019 levels in April. It was month 29. So we're talking considerably faster, right? Basically 2 to 2.5 years faster than we saw in past cycles. Pretty impressive. And as of July, which is month 32, US Revpar is 1.5% above the prior peak on a trailing 12-month basis. Now, the slope of that line has started to level off a little bit, but well above where we were in past recoveries. And obviously, this is a nominal fact. This is nominal and not inflation adjusted, but it really does point to the idea of how fast things snap back. And as we look at occupancy, it paints a similar but slightly different story. Again, the dark blue line is this cycle, and this recovery, the dashed lines are the prior 2. And what you see here is basically occupancy peaked prior to the pandemic, then dipped down, started a really robust recovery, but has started to level off, just like we saw with Revpar. The difference is it's leveling off at a lower level. So following 9/11, it took 65 months to get back to prior peak occupancy. Great financial crisis, it took 81 months. We're 38 months in thus far, as of July, and occupancy seems to have plateaued over the past 3 months in that 92 to 93% of prior peak levels on a trailing 12-month basis. We haven't really seen it move a lot those past few months. So there's just some point of concern there that we're not seeing that trend moving higher. It's not ticking back up. It doesn't mean to say it won't reaccelerate, but it's something to be mindful of. And then ADR, if Revpar is doing well and occupancy isn't doing quite as well, that means ADR must be doing better, right? That's exactly what we're seeing here. ADR, again, fell further than past cycles, recovered faster than past cycles. By month 25, ADR was back to above prior peak levels. After the great financial crisis, it took 52 months, and after 9/11, it took 45 months. So again, 2 years faster than what we've seen in past cycles. And this just points to the idea that like this recovery has been very, very, very fast. And that's a great thing. It's been a little bit hard to predict and hard to forecast, but it's certainly positive for the hotel industry that we bounced back as sharply as we did. We've got a lot of momentum right now as we move forward. When we think about hotel values, and this is data through 2021, we'll get to the 22 and beyond a little later on. But what I just want to highlight in terms of data through 2021 is values dropped 27% during the great financial crisis. They didn't recover back to 2007 levels until 2015, 8 years later. But then by 2018, 3 years after that, they were 18% above the prior peak. So you saw a massive value expansion in the last cycle and continued value recovery. So it pays to buy earlier on in the recovery, and you end up making a lot of money if you can. Values began declining in 2019 in advance of the pandemic, like we talked about in the past, and similar to what we saw with occupancy. We estimate that in a fully transparent environment, values were down 23% in 2021, but then recovered considerably in 2021 to just 7% below 2019 levels. And we estimate that 2022 values are back to 2019 levels. While there are certain markets, but that may be the case, on average, we think it is. Convention demand. This is always an interesting thing. So we track 30 of the largest convention centers around the US. We get pacing data from them. And 2022 is pacing up 153% from 2021 levels. That's great, but it's still 17% below 2019 levels. Now, the good news is that 17% below is heavily skewed to the first quarter of this year when we had the Omicron variant. So as things continue to, as we continue to move past that, we're going to continue to see improvement. And if you look at 2023 and 2024 booking basis, we're literally just below 2019 levels now, gaining ground. Wouldn't be surprised to see those past 2019 levels over the next 6 to 9 months. So while group is normally the slowest segment to recover, with so many definite room nights on the book, a lot of pent-up demand, we actually think convention group, especially, but even in-house group, is going to snap back much faster than in past recoveries, and that's very encouraging for the industry. Now let's talk about personal savings rate, and this is where things start to get a little interesting. So we had an unprecedented savings rate coming out of the downturn. Unfortunately, that's moderated. Basically, this is the amount of savings that the average American, has in the bank accounts, right? And what you saw is a massive spike and then a second spike tied to fiscal stimulus. And what that created was, when you think about leisure travel, it's really driven by two components. One, an ability to travel financially, and two, a desire to travel, right? And the two combined generate a propensity to travel, the ability, which will lead to, leisure demand, which is great. This is a great indicator for the financial situation for leisure travel. And what we saw immediately coming out of the pandemic was that you had this massive pent-up, savings related to the fiscal stimulus, coupled with a pent-up desire to travel because you had been cooped up and hadn't done much and needed more social activity and getting out and seeing the world and doing all those things. And that is translated into historic levels of leisure demand in 2021 and 2022. Unfortunately, where we are now is we're back. All that, when you think about, all that spending on travel coupled with elevated inflation, rising gas prices, incremental discretionary spending over the past couple of years, that's translated into a personal savings rate that is now back to the lowest level since 2016. And as a result, what's going to end up happening is we think leisure travel starts to moderate on both fronts. The financial means to travel is still there. Do not get me wrong, and people will still travel, but it's not that same abundant level of means that they had over the past couple of years. And that pent-up desire to travel after being cooped up during the pandemic has moderated quite a bit as well. And we think this chart kind of highlights some of those challenges that we're going to see moving forward, and we'll talk about it a little more in greater detail in a little bit. When we think about corporate travel and how corporations are doing, I think there's a few things that we'd highlight. Number one is it's been a tough year for the stock market, and that's going to weigh on a lot of different a lot of different companies and industries and markets, and it's something to keep in mind. But the other thing to keep in mind is that the S&P 500 index is still almost 20% above year-end 2019 levels, and corporate travel isn't anywhere near 2019 levels. So there is still a lot of pent-up corporate travel that can materialize, and the financial situation of most companies across that tend to travel have the capability to travel. Financially, they're in strong footing. If you look at how sector performance has been for most of the sectors that really drive hotel demand, technology, financial services, professional business services, government, all doing just fine relative to 2019 levels. And that gives us some confidence that travel will be there. I know there will be a lot of questions about, well, what about all the layoffs that are happening? Goldman Sachs, got leaked that Goldman Sachs is going to be laying people off next week. I don't know if anybody here works for Goldman Sachs. If you do, good luck with that. I hope it's fine. But the reality is the big financial services firms lay people off every quarter. This is nothing new. It's not really driven by, the economy is falling apart. They may use that as an excuse, and the media may highlight it as saying, hey, this is the risk to the economy. At the end of the day, that's just part of their business model. And it doesn't necessarily mean that they're pulling back in any way, shape, or form. So just something to keep in mind. There will be some challenges related to employment and layoffs, and we'll talk about that in a little bit. But ultimately, we feel like the corporate segment is on pretty good footing relative to 2019, but there are challenges related to it, which we'll get to in a second. And then the last thing I'd add about why this cycle is different is just the level of fiscal stimulus. Following the 2022 climate bill, which was another $700 billion, we've now got almost $7 trillion in fiscal stimulus that's been passed from 2020 to 2022. It's 35% of pre-pandemic GDP. Compare that to just under 1 trillion in the Great Financial Crisis, which was 6% of pre-recession GDP. So this is a staggering amount of fiscal stimulus, and that is going to ultimately, and that's propped up the economy over the past couple of years, but we're going to have to pay it we're going to have to pay it back over the next few, and that's going to weigh on economic growth, which is one of the factors that's driving inflation higher, also weighing on interest rates and some of those challenges that we're going to see in a little bit. So just something to keep in mind, fiscal stimulus, big numbers. All right, let's talk about the economic outlook. And before I talk about the economic outlook, the first thing that I'm going to say is I'm not an economist, right? I don't claim to be an economist. I don't want to be an economist. Where Lark operates is basically at the intersection of economics, data analytics, and the hotel industry. We know enough about all three of those things to combine them together to make articulate and what we believe detailed and accurate outlooks for the hotel industry. That's exactly what we do. So when we think about the U.S. economic outlook, the primary factors driving the lodging industry, like GDP, it's a tough first half of the year, right? GDP was negative in 1Q and 2Q. However, you probably didn't feel that if you own a hotel or you manage a hotel or you work at a hotel, because fundamentals were improving pretty dramatically and you're starting to feel pretty good about things. So it kind of points to sometimes the actual GDP numbers aren't really what's driving hotel demand. And it's just important to keep some of that perspective and understanding what really is driving it. The good news is that the expectation for 3Q is that GDP is going to be up 1.7%, and for full year, it'll be up 1.6%. And GDP is going to grow at a 2.3% compound annual growth rate through 2026, an acceleration from 2022 levels. That's great. Unemployment. The U.S. is practically at full employment right now. And the Fed has made it clear that they want to break the employment market by raising rates. They're worried about employment that's too high, unemployment too low, employment levels that are too high. It's not in equilibrium, creating challenges for inflation, things like that. And as a result, they are looking to break that. So don't be surprised to see unemployment rates start to tick back up over the next 12 months. But labor issues remain intact. Inflation will moderate beginning in the third quarter, and it'll be below 3% by 2023. Hopefully that's right. We'll see. That's what Moody's forecast is, and we'll get to that in a second. Interest rates will continue to move higher, including Moody's forecasts a 50 basis point hike in September, followed by subsequent 25 basis point rate hikes until the Fed reaches the 3.5% level in 2023. Now, what's kind of interesting about that is that the 10-year Treasury yield is expected to end the year below where it is now, about 25 basis points below where it is now. And we'll get into that in a little bit, but it just points to the idea that there is so much risk being built into everything right now, and uncertainty, that the Treasury yield is higher than where we think things will play out, even as the Fed raises rates higher. I shouldn't say we think, as Moody's thinks. So what are the risks to continued lodging recovery as we think about the economy? Obviously, there's new COVID-19 variants. There's not much we can do about that, other than be mindful that it's a risk out there, that we think that variants like Delta and Omicron are going to be a much more limited risk than we've seen in the past, but a new variant that is vaccine resilient or therapy resilient or more aggressive with children could be much more meaningful. Not saying those are going to materialize, it's just things that we think about. Persistently elevated inflation and supply shortages is a risk to the economy, and increasing interest rates are a risk to the economy. While it is possible that a brief mild supply inflation-driven recession could occur if these things exceed equilibrium, our outlook right now is that it will not, and has not as of yet. And I'm going to walk through that in a second. So inflation is going to moderate. So what we've got here is Moody's Analytics forecast for inflation at a bunch of snapshots in time on a year-over-year basis, and the Wall Street Journal consensus estimate for inflation. And the good news is everybody thinks it peaked in June of 22. And Moody's expected to drop down really dramatically in the back half of this year. And by December, it's just 3.4%. And by June of next year, it's down to 2.3%. The Wall Street Journal consensus estimates aren't quite as aggressive, but we're seeing a really big pullback. And by June 2023, it's down to 3.9%. And by December, it's down to 2.9%. So at the end of the day, both Moody's and consensus estimates are saying that the Fed has done a good job getting inflation under control, and they're less worried about that, which is a good thing, because inflation is one of the big risks related to the economy. Supply constraints, other big risk. It's estimated that supply chain disruption cost the global economy a full percentage point of growth in 2021. China lockdowns, which had been moderating in May, are now ramping back up. There's now 60 million people under some form of lockdown in China, including Chengdu, Shenzhen, and Daqing. As a result, there is risk that we'll see more supply-related issues. And then the war in Ukraine has obviously caused massive supply shortages for energy, oil, gas, natural gas, food and grain, all these issues. I don't think anybody thought the war in Ukraine would still be going on by September, except maybe Ukrainians. But Ukraine has proven to be extremely resilient, and this has been a much longer war than a lot of the Western economists had predicted. And as a result, it's having an outsized impact on supply issues. We do believe that the war will end at some point. And we don't think that you're going to see additional sanctions on Russia. And we don't think the West is going to enter the war. But we're still going to have challenges related to supply, particularly related to food, grain, oil, and gas. Rising interest rates. Let's talk about rising interest rates. This chart here is the 10-year Treasury yield going back to 2000. The 10-year Treasury yield, for those of you who remember from your finance classes back in college, is the de facto risk-free rate, right? It's the risk-free rate in the U.S. because it's basically, if you're betting against the U.S., then you're betting that the government's going to falter on their debt, and that could translate into the government collapsing, or any policies collapsing. Maybe property gets seized, et cetera. The reality is this is the risk-free rate for all intents and purposes. The Federal Reserve has raised the Fed funds rate 225 basis points year to date. They've hinted more increases are coming. When you think about the Federal Reserve, the Fed's policy, there's two key risks. One we don't think is a real risk. The other is a risk. And that one is the one that's not a risk. The idea that, okay, two risks. Because control of inflation is beyond the Fed. The Fed acted too late. They can't, they haven't, they have to raise interest rates far too aggressively, and it's not going to quell inflation like the Fed is hoping, and inflation is going to tip the U.S. into recession. However, as I've talked about, recent data points suggest that inflation is beginning to ease. Economists have now lowered their inflation outlook over the next 6 to 12 months, and that's very encouraging that things are getting better. The Fed has done its job there. The other risk is that the Fed continues to do its job for too long. They remain hawkish for too long, tightening monetary policy past the point of equilibrium, swinging us past that, that Goldilocks zone where, rates will limit inflation, but not lead us into recession, but moving us past that point where now it tips economic growth into a decline and we see a recession. Given the Fed's comments about trying to break the historically low unemployment levels, this seems like a real risk, and it's something that we monitor. It's not an underlying assumption in our models, but it is something that we think is real and needs to be thought about. It needs to be considered, which is something we do. The reality is increasing interest rates are going to undoubtedly slow economic growth, but as inflation moderates, the Fed will have ability to be less aggressive, and as they're less aggressive, we think it'll squash some of the market fears, which would be a positive. Some of our assumptions, COVID-19 and fiscal policy assumptions. We assume the Fed's going to raise rates another 100 basis points this year. Elevated inflation will begin to moderate in 3Q, like we're seeing already. Labor supply constraints and wage growth will remain in place for the hotel industry well into 2023. There will be no new variants of COVID-19 that impact the children or vaccinated in any meaningful way. And the US does not fall into a mild recession over the next 12 months. So let's talk about our lodging outlook, why you guys are all here. So here's the big issue that we see across the industry: return to office or lack thereof. As you guys all know, people have not been coming back to the office to the level that, was the case in 2019, right? The reality is the variants, Delta and Omicron, really altered plans to return to office. And almost all companies have now adopted some form of a hybrid approach to their office employees. Part of that is driven by the employment market. Part of that is driven by uncertainty surrounding the pandemic. Part of it is driven by fiscal decisions. All of the above. At the end of the day, office utilization is extremely low. This is data through August. Unfortunately, I got the data this morning through last week, and basically it's the same, where office utilization rates remain around 43% of 2019 levels. They haven't really moved around a lot over the past 5 months. Just stayed really, really modest relative to 2019 levels. If people aren't in the office a lot, it's going to translate into less corporate transient travel, because there won't be as many travelers to go see those people when they're not in the office, because you're not going to see them when they're working from home. So I'm not saying the trips get reduced, but the trips maybe get shorter and get truncated into certain days of the week when your counterparts are going to be in the office. And that just limits overall hotel demand for corporate transient travelers. On the flip side, we think it could be positive for pricing power, and I'll get to that in a second. So when we think about the demand segment recovery and how things are working, and I'm going to start with corporate transient, which is this dark blue column here, indexed to 100 for 2019 levels. We estimate it dropped pretty massively in 2020, almost 50%. It started a slight recovery in 2021 and continued in 2022. It will continue in 2023 before it starts to level off a little bit. And ultimately, corporate transient is going to be about, in 2026, corporate demand travel volumes, right? Corporate transient travel volumes, demand of his room nights sold to corporate transient travelers. We're not talking about ADR or Revpar, just room nights sold is going to end up in 2026 about 10% below where it was in 2019. And it's a gradual recovery to that level. So it's not that exciting in our view for corporate travel. The flip side is group. Group is the middle blue bar here. Dropped massively, down 60% in 2020, started to recover in 2021, continues to grow, and we think it continues to grow. And by 2024, it's above 2019 levels. And part of that is driven by the fact that if people aren't in the office a lot, like seems to be the case with this hybrid working environment, then two different things are going to happen. Number one, when conventions occur, you're going to send more team members to the convention for team building, camaraderie, all those things. And number two is you're going to do more team events for the company itself, whether that be in market or outside of market in terms of a retreat. Those things will all benefit group travel and group demand. So we look at that as being positive for the group segment. And then the third thing that I will add is leisure transient. So leisure transient, here we are, the last column in 2020, started to pick up in 2019, started to pick up in 2020. We estimate that in 2021, leisure transient demand volumes were about 75% above where they were in 2019. Massive growth. They pulled back in 2022, but we're still talking about 50% above 2019 levels. Unfortunately, we think they're going to continue to pull back in 2023. But ultimately, we're going to see them stabilizing around 130% of 2019 levels, so 30% above 2019 levels, which is a really strong number, but means there's a pullback in leisure travel from 2021, 2022 levels moving forward. And if corporate transient and group transient aren't growing fast enough to offset that, it's going to create some challenges across the industry. And that's one of the things that we're watching really closely, especially related to corporate transient demand and the pace of that recovery, which just seems to be relatively sluggish right now. So real quickly on supply, our general view on supply is pretty positive. We think that supply is going to stay relatively muted. It will pick up going into the end of this year and into next year related to some of the openings that we've got that we forecast, but then it starts to moderate as you move through next year, drops down to a trough of about 0.9%. And we're focused on the bottom chart here, which is economic supply, taking out the impact of temporary closures and openings. 0.9% in 2024 before it starts to pick back up again in 25 and 26. So pretty benign supply growth across the industry over the next few years. That's a very positive sign and very encouraging. When you look at our Revpar Outlook, this is just our model. The dark blue line is actual Revpar on a seasonally adjusted basis as reported by Smith Travel Research. The light blue line is the model that we use to forecast Revpar. Our model has a 99.5% R squared, which basically means it forecasts 99.5% of all the variability of Revpar historically going back to 2000. You can see how accurate the model has been historically and where it's saying Revpar is going. And I'll give you the actual numbers in a little bit, so you don't need to try to do the math on the chart. The drivers of our model are unemployment rate, GDP, business investment, and foreign exchange rates. Our ADR model looks awfully similar to our Revpar model, 98.7% R squared here. Again, model is historically extremely accurate. And you can see where it's forecasting. Drivers are a little different, still have unemployment rate, you got business investment, consumer confidence, and inflation here. Let's talk about expenses a little bit. So when you think about expenses, we estimate property taxes are going to continue to grow at a relatively elevated pace. Certain markets are different than others, but we forecast a 4.5% CAGR over the next 5 years. Moody's Analytics expects hotel industry wages to increase at a 5.9% compound annual growth rate through 2026. Good news is the massive elevated wage growth that we've seen in recent quarters has begun to moderate, and it will slow, but you're still looking at 6% growth next year before it drops down to around 5% and a little below that in 24, 25, and 26. Overall, hotel EBITDA will exceed 2019 levels in 2023. based on our outlook, and will continue to grow in 2024. As we move to interest rate and the impact on cap rates, and this is something that we incorporated into this presentation a quarter ago because we get a lot of questions. We think we're still getting a lot of questions on it, so I thought it made sense to walk through this one more time. What this chart here shows is, and for whoever raised their hand, just bob a question into the Q&A. We'll address it when we're at the end of the presentation. Hotel cap rates. So what you see here is U.S. hotel cap rates historically. What you see down here are 10-year Treasury yields, what we refer to as the risk-free rate, right? That we talked about earlier, the government bond yield. The difference between them is what we call the spread. And what's interesting here is if you go back and you look on a rolling 4-quarter basis, there is a negative 4.4% correlation and a 0.2% R squared between 10-year Treasury yields and hotel cap rates. They just put Treasury yields, bonds moving higher does not drive cap rates. Other things drive cap rate performance. It's just fascinating to take a look at that, because what ultimately happens is, if you look here, interest rates increase the cost of debt, which translates into a higher cost of capital, and those cap rates should expand, right? But in the past, at least historically, when interest rates have increased, it's happened during periods of economic stability and prosperity. And that means there's low risk, right? Economic stability and prosperity translates into low risk. If you have low risk, your cost of equity goes down, offsetting the impact of rising cost of debt, right? So for simplicity's sake, we measure the cost of equity by the spread between the cap rate and the Treasury yield. And what you can see here is that those two historically have moved in opposite directions almost by the same amount. It's pretty staggering that how that unfolds. In fact, there is a negative 97.2% correlation. Remember, it only goes up to 100%, you know, and a 94.6% R squared between them. So basically, historically, as interest rates go up, spreads compress, offsetting the impact on cap rates. That's what's happened historically. To look at that chart a different way, all I'm doing here is inverting the spread. So putting a negative sign on the metrics. And now you see how close those two lines move just in opposite directions, which is what we're trying to show here. So what's going on right now, right? What's happening? Well, for the first time in 50 years or so, interest rates are rising during a period of economic risk. Federal Reserve is raising the Fed funds rate to combat elevated inflation. As a result, to temper inflation, the Fed will have to continue to raise rates more than the economy can support, pushing the U.S. into potential recession, right? That's the fear out there. That's the risk. The reality is that Wall Street Journal economist survey that I quoted earlier indicates a gradual increase in the likelihood of recession, with 18% in January to 28% in February, now 49% in July. So that increased risk is translating into increased spreads, right? Those two things go together. And while at the same time, we're seeing increased base rates because the Fed is raising rates. So we're in a unique situation where those things are happening at the same time. That is unlikely to continue. One thing will give, one way or another, things will give. It is unlikely that you will see the current environment where cost of equity is going up and cost of debt is going up, is going to persist for an extended period. But until then, spreads will probably remain wide. As a result, we would argue that patience will pay off. Historical relation between spreads and base rates will return. With the outlook across the board for base rates continuing an upward trajectory, that probably means that spreads could compress. Until then, it will pay to be patient. We think that'll play out in the near term. So our cap rate model, which has a 98.4% R squared, basically highlights that we expect cap rates to basically stabilize right around where they were pre-pandemic. No big changes there. We've got BAA bond yields, high yield bond spreads, foreign exchange rates, GDP, unemployment rate, and lodging supply as the primary drivers of our model. So let's take a look at our forecast and compare it to everybody else. So at Lark, we're expecting occupancy this year to be 61.3%, ADR 149.23, Revpar 91.53. Next year, we've got some modest growth. ADR is continuing to pick up, et cetera, and continuing to move forward. What we'll highlight is that if you look at our numbers for 22 and 23 relative to the other guys out there, we are the most cautious on occupancy, and we are the most aggressive on ADR. We have been that way since the start of the year, and we believe we will continue to be that way through the remainder of the year. The reality is other guys have been bringing their occupancy metrics down a little bit. We still think they're too high, and we'd argue that ADRs across the board may be a little light. I wouldn't be surprised if we have to raise our ADR forecast again, just because of the idea of, the strength in pricing power that we have not seen in the past across the hotel industry and the psychology of that. So just some interesting data points related to how our forecast stacks up relative to everybody else's. Now, the reality is some of you are saying, okay, so you're way different than everybody else. Why should we trust you? Well, if you trusted us last year, you would have been more accurate, right? Last year, if you look at the data going into last year, November 2020 for 2021, we were by far the closest. We missed occupancy by 160 basis points. Nobody was within 3 percentage points of us. We missed ADR, but we were closer than everybody else. At the end of the day, we were 2 to 3 times closer to ADR or Revpar than any of the other primary forecasters last year going into the year. And I think that's an indication of our confidence moving forward. So when we think about the key takeaways from our US forecast, we forecast ADR, Revpar, and values to recover to 2019 levels this year. EBITDA will get there next year. Occupancy is going to stabilize below 2023 levels because of the corporate transient challenge that I talked about earlier. We now expect supply growth to slightly exceed our expectations from June, and that's really just related to the timing of openings more than anything else. It's not about new openings occurring. We continue to move our ADR growth outlook higher, and that is offsetting a slight decline in occupancy. So our Revpar metric this quarter changed a whopping 5 cents for the year. Basically unchanged Revpar from June to September, but because of the shift to more ADR and less occupancy, it impacts hotel EBITDA and hotel values. And that's basically an outlook of where things are this year versus last quarter, as well as our outlook for over the next 3 years and over the next 5 years for all these key metrics. And we think about the hotel value recovery. Values began declining in 2019, like we talked about before. We talked about the estimated decline being very comparable to what the financial crisis was. However, the bounce back has been much, much sharper, right? We estimate values snap back 22% in 2021. And we think in 2022, values recovered to 2019 levels, and they'll get back to prior peak of 2018 in 2023. However, as you'll see here, we estimate that values will peak in 2024 at about 5% above 2018 levels before they begin to decline as rising cap rates and slowing top line growth contribute to a decline moving forward. This quarter, we've launched price scout forecasts within our US outlooks, and this will give you a sense of where our price scout forecasts are going. The chart on the left shows you year-over-year growth for 2022 and 2023. Chart on the right is relative to 2019 levels, which I'm going to basically, obviously, what our general expectation is that growth is really going to slow in 2023 from 2022. Strongest growth in 2022 is really driven by those sectors that had the most to recover from because they didn't see as much experience in 2021 in terms of recovery. But as we move to 2023, that starts to change a little bit. And now we actually see strong growth in upper upscale related to corporate transient and group recovery. Same thing with upscale and luxury, while the lower tier segments, which are more leisure oriented, don't perform quite as well in 2023. But overall, when you look at relative to 2019 levels, luxury in our view is the clear winner. Economy, which has been very robust, is going to basically, I don't want to say plateau, but largely stabilize in 2023. Mid-scale will be about flat in 2023, and you'll see some of the other segments continue to grow that are more corporate oriented as that corporate travel recovers and leisure starts to wane. Let's talk about markets. All right. So as we talk about markets, our approach to market forecasting is trying to understand everything that is driving a hotel market in one place. And this gives you a list of everything that we look at, as well as incorporate into our typical market intelligence reports and our forecasts. Our approach, as you guys have all heard before, is transparent. We are market centric, and we are data driven, plain and simple. Where our forecast methodology is multivariate linear regression, similar to the charts you saw for U.S. occupancy or ADR, Revpar, and cap rates. We do that for every market, for every fundamental. And then the last thing I'd say is, and this is something that we think is very, very important, is better data in equals better data out. Garbage in equals garbage out. You know, if you don't know what data you're plugging into your models or what assumptions they're making and what they're relying on, and it's not that helpful to you. We're an open book. We believe in only using the best data sources out there to help build our models and make the most informed decisions. Because at the end of the day, if you're reliant on bad data, you're going to get bad results. And we see it time and time again. And that's why we focus on only the best data providers out there, which is what you see here. So that being said, fortunately, our client feedback is phenomenal. Clients love the work that we're doing, which is great, whether it be Wall Street firms or private equity or REITs or third-party operators or owner operators or brands or brokers or lenders. Our client list runs the gamut. It's basically a who's who in hotel investments. And the good news is they really love the work that we're doing. We have almost a 100% repeat renewal rate. Because the clients value the work that we do. The only clients that we have not had a repeat renewal from are those that have exited the hotel space. So can't really fault that. Can't really fault us on that one. Our market coverage, we currently have 47 markets under coverage. This is a list of all the reports that we put out on a quarterly basis. We do a lot of commissioned reports as well for smaller markets or sub-markets or price scales, et cetera. We're also going to be adding a couple more markets later this month, bringing us up to 49. But this gives you a sense of what we're going to be talking about when it comes to markets. So let's jump into the markets. So these are those 47 markets. One of the things that I think is really important to highlight when we think about the markets is there is a conception out there by savvy, astute investors that if I find the markets that have the strongest economic growth, it's going to translate into the strongest Revpar growth or strongest demand growth. And you know, intuitively that makes sense, but the reality is there's more to it than just understanding the generic economic growth or gross metropolitan product, GMP. You have to actually understand what factors are driving that to understand whether those factors are driving demand for hotels and pricing power for hotels. So if you look at this is year-to-date Revpar, June through June 2022 versus June 2019, compared to economic growth over the same period. And what you can see is there's a negative correlation in an R-squared of just 1.3% over these 47 markets. Stronger economic growth has had no relationship with stronger Revpar growth. Weaker economic growth has had no relationship on weaker Revpar growth. In fact, you look at San Jose right here, all the way over, second to last, second to lowest Revpar growth, second to the highest economic growth. The factors driving the economic growth are not driving hotel demand. And understanding what factors drive hotel demand is what separates a winning investment and a losing investment. And that's what we do at Lark. Flip side of that, look at Palm Beach. Highest Revpar, right, relative to 2019 levels year to date. But economic growth, all the way down here, 24, right? Middle of the road, middle of the pack. Understanding these dynamics, I think, is incredibly helpful. And that's what we try to do by breaking down what the real drivers of hotel demand and hotel Revpar are and pricing power at each market. So when we look at our 2022 outlook, Revpar growth, you know, there are two charts here, 2022 versus 21 and versus 2019. I'm going to focus on the bottom one because the top one gets skewed by year-over-year growth in 2021. So if we look at the bottom one, which is relative to 2019 levels, you're going to see, not surprisingly, The Mobile, Palm Beach, Charleston, Tampa, strong performers. 26 of the 47 markets that we track are projected to have Revpar that is above 2019 levels this year. They generally have an outsized concentration of leisure demand. Bottom performers, San Jose, San Francisco, DC, Minneapolis. We're looking at fly to, high density, international focus, tech exposure, low leisure exposure in general. When you look at kind of the pace of recovery that you see here, virtually all of the markets that we track will have reached 2019 levels by 2023. There will be a few laggards in 24, 25, and 26. But if you look down here, one of the things that we highlight here is showing just because the year of recovery is faster does not mean that by 2026 you're going to have stronger Revpar on a relative basis. What you see is that there's a lot of markets that will recover earlier on and end up lagging Revpar in 2026 relative to markets that will recover in 23 and 24. So it's just something to keep in mind that the pace of recovery does not translate to stronger growth looking out 5 years. And then as we look at top performers 2026 relative to 2019 on Revpar, Vegas, Charleston, Palm Beach, Memphis, and Mobile are our top 5. We think they are the 5 strongest. As you will see, they are pretty much all leisure oriented. Mobile includes all the beaches around Mobile. So they've all been strong to date, and we think they will. Not only have they been strong to date, while we don't necessarily see massive increases in Revpar growth and ADR growth over the next few years, we also think the gains that they've made will largely hold, which is kind of interesting. And then when we focus on values for the 32 markets that we track values for, our favorites are Tampa, LA, Houston, Nashville, and Phoenix. And this is just a dynamic of Tampa. We really love strong economic growth, moderate supply growth, outsized exposure to domestic leisure demand, good convention calendar. We think Revpar is going to be 36% above 2019 in 2026, ADR 41% above 2019, EBITDA 50% above 2019. Even with some cap rate expansion, you're still looking at massive value appreciation in Tampa. LA, you've got a strong economy driven by the entertainment sector, which is going to continue to grow and be robust. You got massive infrastructure expansion. You've got the college football playoff in January of this year, February of this year, January, and you have a World Cup in 2026 and the Summer Olympics in 2028. Massive airport expansion project going on as well. Economic growth is going to be strong. In general, we feel really good about LA as well, although we really like West LA much more than downtown LA. So downtown, there's a lot of supply and not as many demand generators. It's a different dynamic, but we really like West LA. Houston, this is an energy play. Shouldn't be too surprising. We think Houston will continue to be robust. And 2019, which was not a peak for Houston, is a very low bar for Houston, and that'll be good for investments in that market. Nashville, we continue to be believers in Nashville as you're bringing in more high-end properties. You're continuing to see ADRs pushing higher and higher and higher across that market, which is going to drive hotel EBITDA higher across the market and values higher. And lastly, Phoenix, great leisure trends, strong economic growth, low cost environment. All of that's a recipe for success. And we don't think cap rates are going to really expand much in Phoenix either. So we feel pretty positive about that market. So that being said, if you're interested in digging into any of the markets more specifically, happy to do it. We do issue these reports on a quarterly basis that walk through everything you want to know about a hotel market in painstaking detail. We spend a lot of time and effort on. We also do these reports on a commission basis for markets outside of the ones that we track on a quarterly basis. If you're interested in digging into a smaller market or a sub-market or something that's more price class specific. And with that, I'm going to stop and take any questions. Katie, you're up. How are we doing?
Good. We have a few, only 3 right now. One, will the slides be available for download or sent via email after the presentation?
The slides will sent via email after the presentation.
And then looking at the chart, which maps out your predicted RevPAR versus actuals, does this imply that you predicted COVID Black Swan event would happen, or is this perhaps showing rolling projections? An example, after you knew COVID had happened, you predicted close to reality the potential resulting impact.
Great question. So our approach to modeling is taking all the information we know today to forecast what RevPAR will be tomorrow. What we know today is that COVID happened. So that is not a forecast from, you're not seeing a forecast in 2010 and in 2007 saying there was going to be the great financial crisis, or in 2019 there was going to be the pandemic. It's saying at this point in time, we know what has happened before, so we're going to build a model using all of that information to forecast what's going to happen going forward. It is not saying, hey, in 2019 we forecasted this.
Perfect. Is there an expectation that the spread between US and international occupancy versus 2019 remains around 5 to 10%, particularly if energy costs continue to decline and travel restrictions prove sticky, making international travel easier going forward?
So we don't forecast, international travel. So I can't, an international RevPAR outside of the US. So I can't really comment on where it's going to go. I will tell you that a lot of it's going to come down to the market. Different regions are going to perform much better than others. There's an increasing likelihood that Europe is entering a recession. Obviously, the war there is having big impacts. Asia, we don't know where the lockdowns are going to end and how that's going to unravel things. So it's much trickier than that. I can't give you without having studied it, really spent a lot of time on international markets to say where things are going. I'm not comfortable saying how the US is going to outperform or underperform. That's not our strength.
Does today's inflation print change your near-term outlook?
Not at all. I think we're continuing to see things starting to moderate, and the data points that we're seeing throughout are giving us encouraging signs that's the case.
Did I understand this correctly? When the interest rates typically rise, the cap rates rise as well, but in current time, the interest rates are rising due to an economic expansion. Thus, the cap rates will compress when rates increase.
So in normal environments, that's what would happen. I think the challenge is interest rates are rising while we're not in a period of economic expansion, right? Interest rates are rising to combat inflation. And as a result, that is translating to rising spreads coupled with rising base rates. What we would expect over time is that either base rates will compress because everybody will be so worried about a recession that all the funds will flow into risk-free rates or low-risk investments, or you will see the confidence in the economy as interest rates continue to move higher, and then spreads will compress. One of those two things is likely to happen. Our view is the latter, where we're going to see more confidence in the economy, assuming the Fed does not exit that Goldilocks zone and is able to curtail inflation without sending the US into recession.
Anything going on in the M&A world with lodging?
I am probably not the person to talk to about that. We've seen a ton of transactions continue to be occurring for individual assets. In terms of M&A, I would talk to your friendly investment banker. I'm sure there's a lot of different things going on, but I wouldn't know of anything public that I could share.
Tech has been such a driver of job growth in many markets, not just San Francisco, but markets like Seattle, Austin, even New York. Do you think a pullback in tech is built into your projections for those markets? How do you see that playing out?
Yeah, it's a good question. So a pullback in tech is built in, but not necessarily in the form of job growth as much as the fact that we don't think tech is having the same impact on hotel demand as it had pre-pandemic. So it's certainly being built into our numbers for San Francisco, a little less in Seattle, where you've got the cloud computing dynamic that's a bit different than what you see in San Francisco and San Jose, but certainly in Austin. In New York, it has an impact, but it's on the margin. So it's definitely having an impact, but again, I would argue that it's much more of the view that you're not going to see the same level of corporate recovery, transient recovery related to tech, as you will other sectors. And in general, we don't we're cautious on corporate transient recovery.
Given the sharp movement in interest rates, how do you think cap rates and discount rates have moved since the beginning of the year?
Yeah, I mean, I think we've seen that, right? Cap rates and discount rates have increased. And I think the challenge is that historically that's not what happens. So our view is that over time, we're going to start to see that shift back as we get more confidence in the economy and not entering a recession. If we're wrong about that, then you're going to end up seeing it shift back because base rates are going to compress. So one way or another, you're going to see things move backward, things stabilize a little bit. It's just about when, not if.
The Wall Street Journal indicated a 49% likelihood of mild recession, up significantly this year already. You mentioned your assumptions do not account for a recession. At what point would you start to factor a recession into forecasts for 2023?
Good question. So 49% is, roughly a 50-50 shot, right? So by no means is that a foregone conclusion. It certainly ticked up from where it was earlier in the year. We are not economists, as I said before. I really rely on Moody's Analytics as our chief economist to drive their views, and we apply their views into our models. Moody's does not forecast a recession right now. They've highlighted the risks that we walked through with everybody today. So by no means do we think that it's a foregone conclusion that we don't enter a recession. But we think right now the risks don't drive us to build that into our baseline assumptions.
If Fed overshoots raising the interest rates, how much longer will the recession last from current forecasts of mild to moderate?
Yeah, I think that's a pretty open-ended question. How long does the Fed push rates too far and too fast? I think until we have an answer to that question, we don't really know. But at the end of the day, if the Fed moves beyond the Goldilocks zone and tips the economy into recession, and then stays hawkish thereafter, it could be a meaningful recession. Now, don't get me wrong, a meaningful recession does not translate to a great financial crisis or a pandemic, but a meaningful recession, similar to the 90s, is not out of the realm of possibilities, and it could last, a longer time, depending on how quickly the Fed is able to adjust back.
Is the violence, homeless problem, general insecurity affecting occupancies, ADRs, etc.?
It depends on the market. I think you could certainly say it is in San Francisco. I think certain markets it hasn't had as big of an impact. In New York, it doesn't seem to be having much of an impact at all. Chicago, I wouldn't say it's having a big impact. But San Francisco, it's had a huge impact related to convention bookings, where the Moscone Center is really lagging. 2023 Moscone bookings look decent, but after that, it looks real bad for several years. And for San Francisco, people don't realize this, but Moscone is a huge component of the market. Moscone generates close to 7% of total room nights across the San Francisco market. You compare that to a city like New York, where it's like 0.5% from Javits. And because of that, if we started to hear back in 2016, 2017, the homelessness issues and the walking around San Francisco, around Union Square and Moscone Center was becoming to be an issue, and meeting planners were looking at alternative options and not going back there because they were getting so many complaints from their attendees. So I think you run that challenge where San Francisco faces real issues, and if other cities don't get a better handle on it, it will continue. It will become an issue for them, some more than others, just because of where the convention center is relative to the hotels and downtown, and where the issues are materializing. Chicago, it's not as bad because McCormick is a little bit away from downtown. New York, it's too small of a driver. But various different cities, it's going to have an impact. I get worried about Seattle and Portland, without a doubt.
You're bullish on Los Angeles. How do rising crime rates and local government overreach impact your view of the attractiveness of the market? Is LA just a few years behind San Francisco and Portland?
Oh, that's a great question. So I do get a little worried about government overreach. especially related to the homeless bill that is going up to voter referendum in November, which would allow, which would require hotels to fill vacant rooms with homeless people. That is a concern. That being said, LA's got too many good things going for it right now from an economic perspective, and unlike a San Francisco or a Portland, LA is such a spread out market. Homelessness issues are massive issues in downtown LA, not so much in Beverly Hills, not as bad out in Inglewood. And I think, our view on LA is very clear that we like West LA a lot. Santa Monica, Hollywood, Beverly Hills. We also think the Inglewood area is very interesting with the new sports and entertainment complex going up over there. But downtown, we think faces a lot of challenges related to massive supply, a lack of demand generators, and yeah, that homelessness issue is a real one.
The slide that implies economic growth to Revpar growth, would you say that the abnormal economic dynamics set off by the pandemic is the reason for this? Otherwise, it would be right to assume that economic growth correlated with Revpar growth.
What I would tell you is that there's no doubt the pandemic and the economic effects of it have exacerbated the challenge. But I think if you look over time, you can see massive divergence between basic economic growth and Revpar growth, because there are a lot of other factors that drive Revpar and in general lodging demand than basic economic growth. At the end of the day, I think that understanding what those drivers are is helpful, as opposed to just focusing on a simple metric that may be directionally correct, but is not going to be that helpful beyond that.
How much do you think hotel values have decreased year to date, given the movement in discount rates / cap rates you mentioned? Does not seem like NOI growth expectations have moved up enough to outweigh the capital markets impact on values.
I don't know. Take a look at recent transactions. Hersha just announced a couple of big trades in Santa Barbara, and another one I think in Seattle. And those trades were very high valuations. We've seen a lot of transactions year to date that have been at big numbers, whether it be Nashville, Austin, you name it. The transactions that have occurred have been at big numbers, and we'd argue that there are buyers out there that don't necessarily need to put a mortgage on today. And that's enabling them to be more aggressive and win some of those bids. I don't think that values have gone down this year. Flip side, I actually think they've risen a little bit.
Do you think the divergence of economic growth and lodging market strength is being locally driven by back to office behaviors?
Wait, can we say that one again, Katie?
Yeah. Do you think the divergence of economic growth and lodging market strength is being locally driven by back to office behaviors?
I think that's some of it, but I think you're seeing it across a lot of different markets in different ways. You've got a much stronger back to office behavior in Dallas and Houston, but you're still seeing the same type of divergence that we're seeing across some other markets. So you can't assign it entirely to that.
And as of right now, that's our last question.
All right. Well, thank you all for.
I think someone just sent one in.
All right. Last one.
Comment on the recent acquisition of Radisson Americas by Choice Hotels.
I think it was a smart acquisition by Choice. Frankly, I think Choice, at the end of the day, my view on brands is that they've become loyalty programs, and it's all about getting your members to want to continue to stay with you and maintain the loyalty programs. There's a reason why Marriott and Hilton have as many brands as they do. It's not because the brand generates value, it's because the loyalty program generates the value. They don't really care as much about the brand and whether they cannibalize one hotel versus another within their system. So with Choice's acquisition of Radisson, it gave them a higher end hotel that some of their customers could aspirational look to redeem points at, which would be attractive. Look, don't get me wrong, Radisson is not Four Seasons, but relative to Sleep Inn or Comfort Inn, it's a nice upgrade. So I look at it favorably from a Choice perspective. All right, everybody, I think that's it. Thank you all for joining us. I appreciate you taking the time. Hopefully you found it helpful. And if we can be helpful in any way, don't hesitate to reach out. And hopefully I'll see some of you next week at the lodging conference in Phoenix. Have a great day.
Thank you.